everyone, me Kevin here. So recovery stocks are selling off because people are, well, now frantic about a recovery not happening in specifically the Eurozone, which is a pretty darn big travel destination. And here is, of course, our Financial Times paper, which says on the front page, a virus surge and new lockdowns cast shadow on Europe's economy. But what does this have to do with the United States? Well, a lot. If we have hyper growth in Europe, we could potentially see more of that growth push towards the United States and potentially risk higher inflation, right? And inflation is the big buzzword that everybody's freaking out about these days because we believe that if we see higher inflation, we'll see interest rates go up, tech will get pummeled, bond yields go up, and the market just collapses. Like the stock market collapses under the weight of higher interest rates. And then if interest rates go up too high, then people with a lot of margin debt or short-term debt end up getting screwed. We get bankruptcies, we get market crashes, a disaster, right? Well, right now, we might not have to worry about inflation, at least in Europe, because, well, shutdowns. Not only is or are Italy and Germany going into new restrictive modes, but Paris is locking down, and Europe in general, the entire Eurozone, is now getting downgraded in terms of how much growth there might be in the Eurozone in 2021. Now, this is in contrast to the United States, where growth is actually projected to be faster in 2021 than we thought it might be last year when we were looking forward to 2021. So we've got good news in the United States, bad news in the Eurozone, but what do we know, or what did I just find out, better yet, about inflation forecasts, and why do inflation forecasts matter? Well, first, it's helpful to know why inflation forecasts matter. First, if you think that this headphone, which let's say you need to buy, or this this is this Beats headset here. I guess it's not really a headset because there's no microphone, although maybe there is a built-in microphone. Hey, this Beats headset here, if you needed this at some point between now and let's say Christmas, and you thought, there's going to be a lot of inflation, we think that this is going to go from, say, $199 or whatever the price is to $250 next year, and it's going to scale up over time, we may as well buy this as soon as possible because we would be getting a better deal, like the price is going up over time. It's kind of like how the price of the Meet Kevin courses go up over time. And this is true. They've gone up a lot over time, but that's because I keep adding value and more content to them. You got lifetime access to the lectures, and I keep expanding what's in them. Anyway, that coupon code down below does expire on Friday, so you can still lock in that pricing for a few days here. That extension, we're officially ending it, and the pricing will change a Friday evening. But anyway, when we expect inflation, we are more likely to spend money on things sooner. I'm more likely to buy a MacBook if I think it's going to be 10% more expensive next year. I'm more likely to buy it now so I don't have to buy it next year. That's at least the argument, and this is something that the Federal Reserve says. The Federal Reserve believes people's inflation expectations lead to inflation or not. Now, this is very different from, oh my gosh, look at grocery prices, look at commodity prices, look at the cost of sheet metal, lumber, copper, brass, sulfur, bullets. Like all these things are skyrocketing around us. And it feels like, oh my gosh, there's so much inflation. It feels like everything is getting more expensive. But the question we have to ask ourselves is, you gotta ask yourself this. I know I got people from all walks watching these videos, and I think it's wonderful, but I just want you to personally ask yourself, do I think over the next 5 years we're gonna see hyperinflation? And don't just think, am I gonna see hyperinflation? I want you to legitimately ask yourself, are these headphones going to be more expensive in 5 years or less expensive in 5 years? That's the question. And then how much more expensive? And that should help you gauge whether or not you actually think there's going to be hyperinflation. And if you think a $200 set of headsets or whatever these things cost is going to double in price, then okay, obviously you align with the belief that there's going to be hyperinflation. Now, what I want to do is I want to introduce you to something known as the Survey of Professional Forecasters that the Federal Reserve Board looks at, and the many different Federal Reserve banks. Now, the Survey of Professional Forecasters is actually really unique because it's basically asking analysts throughout the country whether or not they think there's going to be inflation. So these could be economists, they could be analysts and I'm not saying that they are a part of this because the participants are anonymous for this, but it could be somebody like an economist working for ARK Invest who does models on inflation. Like those are the kind of people who get included in this survey. And you can apply for this, but they will do these the surveying company, the Federal Reserve Bank of Philadelphia and their surveying department does their due diligence on people to make sure they're actually involved in basically dealing with economic projections every day, especially related to inflation. Like, they're trying to get really high quality survey data here from outside of the Fed. So this is not the Fed. This is not the government saying this, which we know those are different. These are the professional forecasters in the United States. What do they think? How bad is it going to get? How bad are we going to see inflation? All right, so let's go ahead and pull up the survey. I'm obviously not going to read you the whole letter here because, well, I already read it, and it's easier for me to just synthesize the darn thing. Basically, on page 1, they're like, hey, when the pandemic struck, we thought inflation was going to be really, really low for a long period of time, but we've recovered a lot faster, and now we think inflation could trend up a little bit, but here, let's show you graphically what we think inflation expectations are going to do. Now, before I show you these charts, there's something really interesting you have to know. I gotten a little confused, and I don't like getting confused because if I'm confused on something, I'm not gonna BS you and pretend I understand it and put some garbage video or whatever together. So I was looking at a particular chart, and the x-axis on the bottom, this was talking about 6 to 10 year projections for a particular chart, and the x-axis along the bottom here showed 2016 to 2021. And I'm like, wait a minute, this is supposed to be for 6 to 10 years out. So I actually got on the phone with the Federal Reserve, and let me show you or play the clip for you of what they said, and then let's synthesize what that means and then get to the results. I think it's pretty interesting because this is what every YouTuber should do when they don't understand something. And quite frankly, what the mainstream media should do as well, but anyway. Well, hi there, my name is Kevin. I was just talking with another one of the staff members about an economic letter that was put out between the Bank of San Francisco and the Philadelphia Fed survey, and I was wondering if I could ask a quick question on it.
Yeah, I'm not quite sure what paper you're referring to, but you can ask if I know anything about it. I'll let you know.
Sure. It says dispersion of short-term inflation outlook, U.S. expectations, 6 to 10 years ahead.
Yeah. Okay. And it's on the horizontal axis, which is of concern to you. It's the concern is what now?
The title is 6 to 10 years ahead, but the horizontal axis gives me dates 2016 to 2021. So I'm not really I'm getting like 6 to 10 years back.
Yeah. Here's the explanation. First of all, I believe we have a similar series that comes from the Philadelphia Fed Survey of Professional Forecasters.
Yes, that's it.
And the dates on the horizontal axis are probably survey dates, not dates of the horizon.
Ah, okay. Okay, so now we understand how these graphs work, or at least you heard them explain it, so I'll give a little re-explanation here. And this is pretty interesting. So what they're saying is, when we look at US expectations 1 year ahead, every time they ask these forecasters, they would say, okay, it's 2017. Hey, what do you all think inflation is going to be in 1 year from now? That's what they're asking. So this point here is, what do you think inflation is going to be in 1 year from now? The top line are the top 25%, and that's not like the top best. Those are just the ones with the highest expectations. So this is highest 25%, lowest 25%, and then this is called the median right here. So roughly the middle. Okay, so in 2021, the survey that was just conducted, the top 25%, or the people with the highest inflation expectation, the professional forecasters, they believe that inflation could go as high as, draw a straight line back, somewhere around 2.6%. That's not hyperinflation. That's just in 1 year, right? So maybe that hyperinflation will come in the longer term, but 1 year ahead, the most bearish people on inflation, the professionals, think maybe we'll be at 2.6%. Maybe. Now, the other people who are a little bit more, like, hey, we don't think we're going to see as much inflation. These guys are like 1.7, 1.8%. And the middle number here, if I draw this straight over on the polygon tool, has us around like 2.2, 2.3%. So, okay, that's not big inflation. What about Eurozone? It's no better over there. In fact, It's like they have even more compression. Like these numbers are actually pretty wide apart. Like if I do, from here to here, see this sort of wedge we've got right here? It's pretty wide. Look at the wedge over here. It's probably like half as large of a wedge that we've got over here in the difference. In other words, they have more consensus over here in Europe. And we can see if we draw this line back here, get a nice straight line. Oop, that's not the polygon tool. We got to turn the polygon tool on, and this works much better. There we go. So we're at about, 1.6% on the high side, and on the low side, we're at like 0.9, 0.8% for inflation. It's crazy. So for 1 year out, not expecting inflation. Let's now go to 6 to 10 years out. Okay, this is the big fear, that's it, that the 2020s are going to be like the Great Depression again. We're going to get hyperinflation, rates are going up, we're all screwed, the economy's going to collapse, okay? These are the 6 to 10 year projections. And remember what the dude said on the phone. The moment on the chart at the x-axis is when the survey was taken for people's thoughts going forward. Here are U.S. expectations going forward. So U.S. expectations for 6 to 10 years ahead are that on the high side, the top, the 25% of people with the highest projections, they believe that based on the survey that was just conducted, they believe in the long run, we might be on the high side around 2.7% inflation. And on the low side, the bottom 25%, they actually think we're gonna match that 2% level. And the median forecast is that we might run slightly above that, which the Fed has never actually achieved their inflation target, which they've only recently had the inflation target. I think it was since like 2012 they started having the inflation targets. And they've never gotten to their 2% target. And so here in 6 to 10 years, society, or I should say the professional forecasters, they actually believe that the Fed should accomplish their expectations and maybe will be a tiny bit behind that, but or a tiny bit above that, 2.2, 2.3%, but none of this is hyperinflation, right? Now, it is true. It's not like they're all below 2%. So they do think, yeah, look, if we keep up at this pace, the money printing that's going on, sure, we can get to that 2%. But that's what the Fed wants. This is not a catalyst for a massive market crash. Is it a shift for preparing for, rates are going to be a little higher? Sure, the same is true in Europe. You look in Europe, they're also thinking on the high side, maybe 2%, and on the low side, around 1.5%. So about 0.5% less inflation than US expectations. But overall, the bottom line messaging here is simple. Professional forecasters don't see hyper runaway inflation. Instead, they see the Fed actually getting close to achieving its goals. And yeah, that does mean at some point in 2023, 2024, rates will go up a bit. Yeah, we'll have some short-term adjustments. But are we potentially, at least based on this survey, going to see runaway inflation that leads to a massive, epic, catastrophic crash because all of a sudden we got 7, 8, 10% inflation because the velocity of money went up or this, that, or the other? Well, at least according to these professional forecasters, the answer is no. And there are a bunch of them. It's not like it's just like a huddled up group of 3 people who want to sell you something. It's an anonymous group of, I want to say somewhere around 50 professional surveyors, and they just regularly give their models to the Fed and say, well, this is what we think in the business world. So there you have it. If you found this helpful, consider sharing the video, consider subscribing, consider checking out those programs, a link down below to build your wealth, and get yourself 2 totally free stocks with Webull by going to mettkevin.com/Webull, deposit $100, and get up to $1,850 in free stocks. Thanks for watching, and we'll see you next time.